you can make $3,000 a month without selling a single share in your portfolio. It only takes 4 ETFs, and I'll be walking through each of these ETFs and how they all work together. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. These days, there's a lot of ETFs with double-digit yields that pay you every single month. This leads some investors to chase ETFs with high yields that might be tied to the same index or sectors in the market. And the big problem is that when that sector or index gets hit hard, so does your income. But having a much more diversified approach could solve that issue. You'll still be holding funds that pay consistent and solid monthly income, but the difference is where that income's coming from, since they touch different parts of the market. So let's get into these 4 ETFs and how you can build a $3,000 a month income portfolio. First up is SPYI, the NEOS S&P 500 High Income ETF. This isn't your typical S&P 500 ETF, since it focuses on income. The goal of this fund is to generate income while using a call option strategy, while also giving you exposure to the S&P 500. And it does this by holding individual stocks from the S&P 500, and then it sells out of the money call options on the S&P 500 index to generate high monthly income. SPYI writes call options on a decent portion of the portfolio, and that percentage could vary depending on market conditions. And those index options come with a nice benefit since they're classified as 1256 contracts, which means that distributions are going to receive 60% long-term and 40% short-term capital gains tax. But keep in mind, a majority of the income that you receive is going to be considered return of capital. And SPYI comes with an expense ratio of 0.68%, costing you $68 for every $10,000 invested, which isn't that bad for an actively managed fund. If we take a look at the top holdings and sectors of this fund, it's very similar to what you'd see in a normal S&P 500 ETF. And that's because NEOS is holding a majority of those same S&P 500 stocks. This fund is all about the income, and it has a dividend yield of around 12%, which is paid out every single month. And SPYI is up around 19.8% in the last year, with annual returns of 15.1% in the last 4 years since it was created. It's been holding up as a solid fund in the few years that it's been around. The strength in SPYI is that it serves well as a core income fund. It's not heavily concentrated in one segment of the market or a handful of stocks to generate that income. And instead, it holds the best and most established companies in the US stock market while also giving you double-digit monthly income. Next up, we have QQQI, the NEOS NASDAQ 100 High Income ETF. This is where the portfolio adds the growth engine, and the strategy is very similar to SPYI. QQQI holds stocks from the NASDAQ 100, and it writes call options on the NASDAQ 100 index, and that income that you receive monthly is from the premiums that it collects. And if you don't know already, the NASDAQ 100 holds 100 of the largest non-financial companies in the NASDAQ index. And while technically this isn't a growth index, it holds some of the best companies that are driving the market today. Also, since QQQI uses index options, it's going to have the same tax advantages as SPYI from 1256 contracts. And for the fees, QQQI has the same expense ratio of 0.68%, costing you $68 for every $10,000 invested. Jumping to the portfolio, QQQI has 105 holdings, and the top holdings include NVIDIA, Apple, Microsoft, Amazon, and others. And it leans heavily into technology and tech-related companies, so again, it's very close to the index holding weights, which is nice to see. QQQI has an even higher dividend yield of 14.6%, which is paid to you monthly. And that's quite a bit higher than SPYI, thanks to the volatility that the NASDAQ 100 comes with. Higher volatility means bigger premiums, and that's more income for you. QQQI steps up in the performance as well, as it's up about 20.2% in the last year, with total returns of 18.8% since it was created about 2.5 years ago in January 2024. The advantage to QQQI is that it gives you more exposure to growth, and it comes with more volatility than SPYI. So you're getting the added benefit of more growth potential and more potential income due to the volatility of the NASDAQ 100. But keep in mind, this added volatility means more risk since this fund is heavily focused on technology. So when tech or growth gets hit hard or sentiment changes, this fund is going to feel it, and that income is not going to be a big cushion. But QQQI is a fund that leans into growth names while also paying you a nice income. So it's a solid way to collect some income for some of the biggest tech and growth names in the market. The third fund on the list is IWMI, the NEOS Russell 2000 High Income ETF. This fund steps away from the large cap stocks that you find in SPYI and QQQI and it tracks the Russell 2000 index. This index is made up from the bottom 2,000 stocks from the broader Russell 3000 index, which holds the largest 3,000 companies by market cap. The Russell 2000 gives you exposure to a wide variety of US small cap stocks. The strategy is the same here, except instead of holding the individual stocks of the Russell 2000, it holds a Russell 2000 ETF and it sells out-of-the-money call options on the Russell 2000 index. You also get the tax benefits of 1256 contracts, and it has the same expense ratio of 0.68% like the other funds so far. Now, I mentioned it doesn't hold the stocks of the Russell 2000 index, and instead it holds the Vanguard Russell 2000 ETF, VTWO, which has 2,011 holdings. And it has companies like Moog, Hut 8, Viasat, MaxLinear, and a few others. With exposure across sectors like healthcare, financials, industrials, and more, so it has a pretty diversified spread of names and sector exposure. And IWMI has a solid dividend yield of 13.7%, which is also going to be paid out monthly. Since this is a small cap fund, that means it's going to carry more volatility and it can provide bigger premiums. But bigger price swings can also affect the consistency of the income levels. For total returns over the past year, IWMI has done roughly 33.3%, and the annual return since it launched in June 2024 is about 17.5%. These incredible returns are because small cap stocks have been taking off from earnings and cheap valuations after being beaten down for a few years. What makes IWMI stand out is the fact that it gives you exposure to small cap stocks, which none of the other funds have. This can be a boost to the income or growth potential of your income ETF portfolio. On top of that, there isn't any single stock in the fund that carries enough weight to move the portfolio. And just keep in mind, while small caps generally have more growth potential than large caps, they also have more volatility and risk. This volatility is great for the income, but that means they'll get hit much harder during recessions and downturns. With that being said, IWMI is a great income fund that can broaden your portfolio exposure and expand the income and total returns of your income portfolio. This last ETF sits in its own category, and that's MLPI, the NEOS MLP and Energy Infrastructure High Income ETF. MLPI invests in American and Canadian MLPs or master limited partnerships along with energy infrastructure companies. And the simplest way to think about these companies is that they're toll booths of the energy world, like pipeline operators, LNG companies, and energy logistics. These are companies that are dealing with the transportation, storage, processing, and refining of oil, natural gas, and other natural resources. MLPI writes call options on the ETF AMLP, and it also gets 1256 contracts tax treatment. And like the others, it has an expense ratio of 0.68%, costing you $68 yearly for every 10K invested. Now, this fund is much smaller than the others with only around 25 holdings. That includes stocks like Williams Companies, Enbridge, TC Energy, Kinder Morgan, and more. This portfolio is small because the filtering for the index chooses the largest 25 companies along with a few other filters, and no stock can make up more than 10% of the index, so it's pretty selective. For the income, MLPI has a distribution yield or forward dividend yield of 14.5% that's paid out every single month. So it's churning out some pretty serious income for you. And since this fund was created in December 2025, it's had total returns, including dividends, of 18.3%, which is really great for the short amount of time that it's been out. One thing to consider is that when you own MLPs directly is that you have to deal with K1 tax forms, which can be a pain. But the nice thing about MLPI is that you won't have to deal with this when it comes to the taxes. Another great thing about MLPI is that it's giving you exposure to an area that the other funds don't touch. Energy infrastructure is not going to move with the broader stock market like a tech, small cap, or even how an S&P 500 fund would. So this added diversification is a big plus. Now, this concentration can and does bring more potential for volatility and risk. A downturn in the energy sector or policy changes could have a big impact on the fund. On top of that, this is a pretty new fund that doesn't have much of a history yet. But exposure to energy infrastructure combined with a high yield can be a nice addition to a well-rounded income portfolio. Now let's talk about how you can combine these 4 ETFs for some serious monthly income. income. In this table, we'll be going through the weights for each fund and how much money it can generate for you. So before getting into what's needed for $3,000 in monthly income, I want to show you the income you can generate from $100,000, since this is a pretty huge milestone to reach when you're investing. First up is SPYI, which would be 45% of the portfolio, and this fund functions as the anchor and foundation for this income portfolio since it gives you that broader diversification. With roughly 12% yield, it's giving you $451 a month and about $5,400 a year. QQQI would be about 30% of the portfolio with a yield over 14.5%, and it comes in at $366 a month at about $4,382 a year. IWMI makes up 15% with a yield close to 14%. It nets you $172 a month, which is about $2,060 a year. And last is MLPI with a yield of nearly 14.5%, which could provide you $121 a month and $1,448 a year. That brings the portfolio to a yield of 13.3%, and it would pay you about $13,300 annually, which comes out to nearly $1,100 a month. That's not bad at all for $100,000, and I wanted to show this example since it's an easier number to wrap your head around. Double this amount and you're looking at over $2,000 a month. Now let's talk about the number that brought you here in the first place, and that's that $3,000 in monthly income. We'll be using the same portfolio setup of SPYI at 45%, QQQI at 30%, IWMI at 15%, and MLPI at 10%. To pull in $3,000 a month with the current yield of these ETFs, that comes to about 13.3%, and you're going to need roughly $270,000 invested. And this is going to generate $36,000 a year for you. What I like about this $275,000 number is that it sheds some light on how much income that you can generate from a portfolio size that fits between the median and the average. For someone in their 60s, the median retirement account is around $180,000, while the average is over $550,000 or so, meaning you can generate some very reasonable income even if you fall in between or even lower, as you could potentially cover your day-to-day expenses, insurances, mortgage payment, and much more. And for those with $500,000 or more, this could easily be $6,000 or more in monthly income with a portfolio setup similar to this. While that income is all well and great, there's still a few very important points to consider. The first and most important thing to point out is that these ETFs will limit your upside potential. Cover call ETFs in general will cap your upside potential since you're trading that potential appreciation for monthly income. So while these funds could offer some decent appreciation, their main focus is generating income. This means you're going to be underperforming the underlying asset over the long term. Next is that the current dividend yields are not 100% certain. These funds are going to pay what the premiums pay out, and that could depend on current market conditions. And we've been in a bull market for some years now, so these funds haven't dealt with a wide range of different market conditions yet. So don't assume that you're always going to see 14% yield for QQQI, for example, or that SPYI could never sit below 10% for a while. Third would be portfolio overlap. For this specific portfolio setup, QQQI with the NASDAQ 100 and SPYI with the S&P 500 have some pretty significant overlap. Tech makes up a big portion of both, and they share those big growth stocks, making exposure much bigger across those stocks. And any negative news for tech or growth stocks could have a decent impact on the portfolio. While MLPI and IWMI both have their weaknesses as well, at least they're providing some coverage to areas where the other funds don't. And fourth is that QQQI and IWMI are going to be much more volatile. Not only can the NASDAQ 100 have big swings from tech and growth stocks, but IWMI is exposed to small caps that are naturally more volatile than large cap stocks. So downturns or recessions are going to hit the small caps harder, as well as the heavy growth and tech tilt that QQQI has. Now, this isn't to scare you, but I just wanted to highlight that it's important to know what you're investing in. But these NEOS funds prove that you don't necessarily need a huge portfolio in order to generate some solid monthly income. And if you want to check out some more NEOS ETFs, I get into some of the best NEOS ETFs in this video here, or if you want to learn about some of the newest NEOS ETFs on the market, then watch this video here. If you made it to the end, thank you for watching, and don't forget to hit that like button and subscribe for more content, and I'll see you in the next one.